Hello, everybody, and welcome to the Crypto Hipster Podcast. This is your host, Jamil Hassan, the Crypto Hipster, where I bring you founders, entrepreneurs, executives, thought leaders, artists, you name it, across the world of crypto, blockchain, all around the world. And today I have an amazing guest. Pretty much all my guests are amazing, but this man is really amazing too. He is, I didn't ask him how to pronounce his name before I started, so I'm going to give him my best shot and he'll let me know. Aakash Athawasya. He's the research
Nailed
lead.
it.
Nailed it. Awesome. He's the research lead at PYOR. Akash, welcome.
Thank you. Thank you, Jamil, for having me. Excited to be on the podcast.
You're very welcome. So let's kick things off and ask you first, what is your background and is it a logical background for what you're doing now?
I don't think anyone in crypto has a logical background. They've just land up because they either like the space or they do something adjacent to it. My adjacent role was I was a journalist in a crypto company, luckily enough, but before that, a financial company. Crypto happened to be the most interesting thing to write about, got into the crypto space. And the evolution of a writer or a journalist in crypto is you either go into the investigative pieces, that would be something covering like the likes of SPF and his trial, or you go into the analytical side. I went to the latter. I went into the analytical and the product side, worked with a bunch of analytical companies, including a company called Wald, which unfortunately went bankrupt during the FTX Luna crisis of 22. I had my own media company in crypto. I had a newsletter with over 15K readers. And most recently, I'm working in a company called PYOR, or PYOR, as you rightly mentioned. The full form is Power Your Own Research. It is a data analytics company that provides fundamental data, fundamental being protocols, revenue, protocols, expenses, if they take home any profit, how many users there are, what is the market data, etc. And I lead research there. We make data dashboards on the B2C side for anyone like you and me to go and use. And also we do custom work with protocols if they want certain specific metrics to look at. And also research reports, both long form and short form for institutions as well as protocols.
Sounds good. So my next question was going to be what PYOR is all about. You just answered that. What makes it great?
So in the data space within crypto, right, we try to segment it, or rather we'll try to unbundle it, right? Crypto doesn't have one data company that does everything like a Bloomberg, right? They have several data companies that do smaller subsets of information. For example, if someone wants wallet level data, they go to Nansen. If they want entity level data, which is wallets collated at an entity, they go to maybe Arkham. If they want research and reports, specifically quantifiable English material, right, that you can actually read rather than looking at numbers, they go to Messari or Delphi, both at an institutional level and at a retail level. If you want shitcoin level information, right, these smaller meme coins, you want to see what people are trading, you go to something like a Bird's Eye, you go to Gecko Terminal, you go to Dex Screener. So there are various data companies. What we do is we look at crypto companies as a fundamental business. Now, how do you look at a business? A business that is public will have a financial statement. It will have a balance sheet, profit and loss statement, and a cash flow statement. Crypto companies have the same thing. And these are open source. These are public. You can look at a company's or a protocol's revenue that they generate, the amount of fees that they give to the L1s, the amount of fees that they keep as L2s, the amount of fees that they give to an L2 if they're a protocol on top of it, right? Beyond this, we look at, like, when you look at a startup, right? When you look at a startup like Uber um, or Amazon, etc., you look at it in terms of how many people are using it, how many orders do you have per day. Those are metrics that an investor looks at to evaluate startup A versus startup B. We can look at the same thing for a protocol. We can look at the same thing for a layer one, layer two blockchain. How many transactions are happening on a blockchain at a particular point of time? Is it increasing or decreasing? Why is it increasing or decreasing? What is the amount? What is the average transaction? Does one blockchain have a high value user, someone who comes and make a 20,000 rupees deposit or a transaction, versus a blockchain that has a low user, right? We can use that to sort of understand the customer base of an asset. For example, BNB or Binance Smart Chain, PancakeSwap is the premier DEX there, right? The transaction fees are so low that the average transaction value, the amount that a random person is coming and swapping, is fairly low, significantly low. It's in fact $200 to $300, which is very low compared to something like a Uniswap, where people are transacting on an average ticket size about $2,000, $2,500. In Curve, which is extremely high because it's a stable coin DEX, it's about $10,000. So we can look at that from a fundamental metric. And that helps a lot of protocols as well as institutions make better decisions, as well as retail customers making better decisions.
She looked at things as a way that an institution would, and I'm trying to think of how an institution looks at things. There's a CFA framework, right? CFA framework is pretty standard, but they look at margins, they look at working capital liquidity, they look at debt capitalization, and they look at return on investment, right? So if you were to do an equivalent of a crypto versus traditional finance comparison using those four categories, what data would you capture, and how would you go ahead and using and put the crypto analytics into that framework?
Great. I'm really glad you asked that question, because if you go to our platform right now, okay, this is a plugin, unfortunately, but we look at the one protocol that we looked at first is the protocol that people, or the type or the category of protocol that a lot of users first time use, and those are decentralized exchanges. You connect your wallet, you go and swap stuff, right? So you mentioned a few metrics there, and I can sort of walk you through how we look at them. For example, a fundamental business metric when valuing a public company with a stock or a share that is publicly traded on a national stock exchange is something like a price to earnings ratio, right? That's a fundamental metric. CFA handbook, everybody uses that. What they look at there is the price of the share, the trading price of the share divided by the revenue or the earnings per share, which is either the revenue or the profit per share, right? Which is, you want to see how much value the company is generating or how much profit the company is generating, which is then divided by, or the price is divided by that, right? To see how overvalued or undervalued the company is compared to its peers, compared to a benchmark, compared to international competitors, etc. People do this for Tesla all the time, Amazon, Google, etc. We do the same thing for decentralized exchanges. Now, the metrics we look at for price, we look at price again, because a uni and a cake and a sushi and a curve, they all have tokens that they trade for, right? That they trade for US dollars for. So we look at that. The underlying sort of denominator there, of course, there's no direct revenue, but we look at fees. What is the fee generated by a decentralized exchange? We look at price to fees as a metric, which is a simple valuation metric. Another thing that we look at is, say, the working capital turnover, which is how much the company is generating on an ongoing basis in terms of actual operational capital. Now, what does a DEX use to sort of operate? It's the LP pools, the liquidity pools that is used as the supply side. So we look at working capital turnover ratio. What is the working capital to the actual turnover, which is the sales that it actually creates? We look at return on capital employed. What is the return on the capital that they employ, right? And we benchmark that against our own index. We have a PYOR DEX benchmark index, which consists of the top 10 DEXs on Ethereum and EVM chains. Do this for other alternative L1s like Solana, etc. Fundamental level, we evaluate that for the protocol itself on an absolute basis, also on a relative basis comparing to peers. So you can go to our platform and see working capital turnover of a uni versus a sushi versus a curve versus a dodo versus a level finance, bunch of others.
I like it. I didn't know that existed. But I'm glad. And so I'm confused a little bit then, because you see a lot of CFAs, you see a lot of traditional finance guys saying that you can't evaluate and measure crypto, but you just lay out a framework where it's very comparable to what they do for the stock market. So why are they not getting it?
I think it's a matter of frenzy, right? Cryptos are looked at mainly at a token level, and they're not looked at a protocol level. So that is the opposite of a company. A company first has company performance metrics, and if they tend to do well, the investors, stakeholders, and management decide, okay, let's IPO, right? Let's have a price per share of the company that people can use as a benchmark. So today, Tesla's trading at whatever, $800, $900, right? And people use that as a benchmark to see that if the price of the share has improved, then the company's performance has improved. That is usually a lagging indicator, right? But in the traditional finance world, these metrics, these financial metrics, these fundamental metrics, these user metrics are A, unknown, B, if they're known on a 3-month quarterly basis. You don't look at it on an ongoing basis. You don't know whether a particular event has triggered a particular reaction on the financial side or the operational KPI side. That is untrue in the crypto industry, where you can see everything and everything is open source, everything is public, and everything is updated on a minute to minute, second to second basis on the blockchain itself. And there are various block explorers where you can go see this data. There are various data platforms, ours being one of them, which you can go and see this data on a minute by minute, week by week basis, etc. The problem that you mentioned is that most people look at crypto as at a token level, right? And they only employ one kind of analysis to it, which is your traditional technical analysis. Your traditional technical analysis only looks at two metrics: your price, what is the actual price and how does it move on an ongoing basis, and the volume, how many coins in terms of the number of coins into the value per coin is actually being traded. And is that velocity increasing or decreasing on an exchange? And most people make their trades on an exchange. By most people, I mean most retail investors like you and I. We make those trades on an exchange, a centralized exchange, something like a Coinbase or a Kraken or a Binance, etc., which does not cover, because they don't need to, these fundamental metrics. But once you click, I think, one or two levels deeper, you look at for a token, right? If you uncover it on a step-by-step basis, you look at ETH. ETH is a token, the native token of the Ethereum blockchain. What does the blockchain do? What is the main metric that it looks at? Transaction counts. How many transactions are going in on a second, hour, daily basis? Then you look at the speed per transaction, the cost per transaction. Who does that expense go to? Does it go to the supplying entity? Does it go to the validating entity, etc.? Then you can break it down further on a protocol level. Which protocol garners the most amount of fees? So these are step-by-step analysis that people do not do because they limit their analysis, unfortunately, to the price and the volume. That is why I think most traditional people don't look into it. But if they do, they realize that there's a large swath of data that is immediate, that is verifiable, that is also understandable at a traditional financial level, like how you read a balance sheet or a profit and loss statement of a company.
This is insight for me because I looked at balance sheet for a year. I built balance sheets for years, so it'd be nice to be able to do that. It sounds like I can. So awesome. Your institutional clients. Well, when you look at balance sheets and profit and loss and the annual reports, you see more than just the three statements. You see additional data, that's in the notes, right? So I'm sure that your institutional clients are asking for additional info, right? So how do you provide them with their key insights they're asking for? Are you meeting their needs? And how, as an industry, can we build these analytics even further?
So our institutional clients, they want to know from a blockchain level, both at an absolute level and a peer-to-peer level, right? What is happening at probably 3 to 4 metrics. So they want to know the operational KPIs. What is the main metric that drives performance, right? So for example, if you look at an Uber, the main metric that drives performance is number of rides, for example, right? Number of rides per customers, number of rides overall, number of rides per square kilometer area, etc. That is the main metric that they look at. If they increase the number of rides, that means the company is doing well. If the rides for some reason go down, then probably it's a problem somewhere, right? So that's the main metric we look at for every protocol. So for example, for your layer 1 blockchain, the main metric to ideally look at is the transaction count. Are people using it? How often are they using it? That's the main metric you look at. For a DEX, it's the swap count. How many people are actually swapping? How many people are actually trading a crypto? For a lending protocol, it's the borrowing volume. Are people actually borrowing lent crypto on it? And what is the rate at which they're lending it at, the percentage rate of interest? What is the percentage rate of interest that they're borrowing at, lending at? And do the lending platform keep a fee? For an NFT marketplace, it's trading volume. How many NFTs are being minted, bought, and sold? So an institution looks at this operational KPI, then they try to understand what kind of users are on the platform, right? What is the daily active user count? What is the monthly active user count? Are people more sticky? Are they less sticky? How many new addresses are generated on a 30-day basis, on a 1-year basis? Is that more or less than their peers? What is the fee that an address pays when they are first acquired versus what they pay ongoing? What is the retention rate at an M1, M2, M4, which is at the end of month 1, at the end of month 2, at the end of month 12, etc. Beyond this, they look at financial metrics, which is where the financialization of the balance sheet comes in, which is what is the protocol revenue? Do they pay any fee? What is the amount that they take home in the form of profit or they keep in their treasury? Then at the end, they look at market metrics, which is what is the price of the token? What is the circulating supply? Do they have any token unlocks coming that might impact liquidity and that might create some selling pressure? So that is looked at on a very protocol level. Then within it, our institutional clients look at, say, bellwethers in the space. So for example, for Ethereum, they look at sort of categories, right? DEXs, how are DEXs performing? How are lending protocols performing? For Bitcoin, they mainly look at the chain itself, but now they're looking at ordinals, right? How is the NFT inscriptions? Is it increasing? Is it decreasing? For Solana, I think there's a huge rush in DEX volumes, right? So a lot of attention is going on looking at how do DEX and DEX aggregators work, right? So these are what an ongoing institution looks at, but they also try to go one level deeper where they have all the metrics in front of them on like a sheet of paper, for example, right? They want to know sort of second level insights, third level insight, which is mainly in the form of, say, a valuation ratio, where they look at what is the DEX velocity of an Ethereum versus a Solana, which basically means that what is the volume, DEX volume on a Solana versus the total value locked on the chain itself, right? That shows how often the chain is being used in terms of trading activity versus the amount that is already there. That's a useful metric. And we recently saw that the DEX velocity on Solana significantly outpaced the DEX velocity on Ethereum. So those are things that people look at on a deeper level. And that's what we provide to them.
Yeah. The velocity for Solana is outperforming Ethereum, and as people are complaining that Solana has a 75% downtime, or transaction fail, but it's because of that velocity. That as protocols grow, the capacity grows too, supposedly. It's interesting because in the traditional financial world, there's lots of different sectors, and you have analysts who look at only one specific sector, right? They're usually the price of ketchup has nothing to do with the price of, I don't know, I was gonna say fertilizer, but toys or whatever. In crypto, everything's interwoven and interrelated. So let's look at some of those outliers, emerging trends that might affect different chains. One of them, first of all, is the Ethereum Denkun upgrade, right? I'm gonna ask you what's that all about, and how's it going, and how has it impacted the EVM and layer 2 in Ethereum?
Got it. The Denkun upgrade is mainly meant to reduce transaction fees by increasing scalability through something called blobs, which is quite funny, right? The name itself, it's think of a layer 2, which is like a superhighway on the main road, right? The layer 2s process transactions. They use Ethereum for storage. They use Ethereum for finality or security rather. But most of the transaction happen on a layer 2, which is like an Arbitrum, Optimism, Base, etc. These layer 2s were also getting filled up with people using them as a highway to sort of commute, or in this case, transact. The problem is it couldn't hold that many. So the Denkun upgrade allowed them to sort of increase data storage, albeit temporarily. I think it's for a period of 15 to 20 days, where they can temporarily store some more transactions, like an extra space. It's not something that was improved upon, but it's like an extra space that they're getting so that they can store more transactions for a temporary period, so that the speed increases and cost decreases. And that immediately happened. I think the Denkun upgrade sort of went through 3 to 4 weeks ago. and the gas fees on Ethereum L2s significantly dropped to a point where they were almost comparable to Solana. And this was when sort of the meme coin frenzy caught hold of Solana. So people were trading for very low amounts in terms of gas fees. And now they could do that, or they can do that on an Arbitrum or an Optimism, etc. It didn't happen altogether. I think some chains had the Denken upgrade slightly later, Arbitrum being an example. Base had it quite quickly. But I think those fees were fluctuating, because when I checked those fees a week after the upgrade, they were almost at the level of before the Denken upgrade. So that was a slight sort of, it was a dissatisfaction point, but it happened. And now I can see, I think before this call, I checked the gas fees on, I'm looking at it right now. Base is about 0.005 for a Uniswap swap, or an overall fee with blobs is about a couple of cents, right? 0.001 cent. And Ethereum, for example, it's still at $10 for a Uniswap swap. I think before this, the last I swapped, it was about $25 to $30. And it's also because the rising price of ETH as an asset, right? So the price was significantly high on dollar terms, but it's good to see that the price has fallen down, although it fluctuates, right? So again, I'm looking at it right now. The lowest L2 fees is $0.005. The highest is almost 10, 20 times that, which is at a Scroll. Scroll is about 0.75, which is almost $1, which is quite high. So it did reduce the fees to a certain extent, although that has come back. But I think as time goes on, they'll have more space to work with, and fees will go down.
You and I, if we're making trades, we like lower fees, of course. So, you know, I want to jump in. I want to jump into the Solana meme season, right? You know, every season, every speculative season has been met with a heavy crash and a winter, right? We had that with the ICOs, we had that with the NFTs. Do you see this meme coin being just a fad? And if it's just a fad, is it going to break? And yeah, and if it does, how's crypto shifted away from the utility and only toward gambling?
Meme coins are generally like the ends of a sort of bell curve, right? They start with the rise. They're the most volatile. They go up the most, but they also go down the most. That has been the case in most seasons, meme coin seasons, right? But they're never the main theme in the past couple of years. They're usually a secondary theme to NFTs, secondary theme to ICOs, secondary theme to whatever is going on. This time they are the primary theme, although it happened after the Bitcoin ETF approval in January. And I think in late Jan, Feb, March, and now in April, we've seen a lot of meme coins being created and go up. But interestingly, it's not on the main chains. So the two main chains where meme coins sort of kicked off, specifically meme coins, not any other sort of outlier asset class, is Ethereum and on native chains, right? Ethereum had, of course, SHIB and Pepe, and others as well. But on native chains being something like a Doge, which is on its own chain. But that didn't happen because the fees were significantly high to trade. And that happened on Solana for a number of reasons. One is people had a lot of SOL to trade because some of them accumulated during 2023 and the price has risen so much that they're like, I don't mind spending a couple of cents on gas fees for this token. So they were willing to give it up, and they were willing to mint and trade a lot of assets. And the other is there was just a lot of attention on Solana because it started with Jupiter. Jupiter had an airdrop. Jupiter is the DEX aggregator on Solana. They had an airdrop towards the end of January. So leading up to January, a lot of people started trading on Jupiter in order to qualify for the Jupiter airdrop. And some of them began trading meme coins, right? And a lot of these meme coins were made in December prior to anything that's happened. In December and January, they started being created and being promoted. But more than that, I think that meme coins aren't sort of a growing fad. They are, in a certain sense, gambling and entertainment, free entertainment, at least on Twitter. But they're more than that. They're like there are social aspect. They're social fires, people call them, where you can garner attention on a particular social topic, create a coin out of it, brand it really well, market it really well, create good content in probably a community as well. And the price of that coin goes up, provided the social interest is strong enough. We've seen that with Dog Whiff Hat and the other Whiff Hat coins. We've seen that with Political Fi, which is the class of coins that were made out of political characters like Trump on Donald Trump and Biden on Joe Biden and a bunch of other American politicians. Now they're creating smaller versions of that, none of which have the sort of social weight to hold the volume. But that's another interesting theme that has come about. But given all of this, the fact that people had sold, the fact that social interest came up, the fact that Jupiter had this airdrop season, the fact that people were trading on Solana, the fact that Ethereum fees were so high, and the fact that Bitcoin also was also approved, Bitcoin ETF was approved, and price action went up. All of this sort of resulted in a meme coin season. I don't think it's going to go away soon. I think there's a lot of volume that is within it, but it needs to translate into actual either social capital that is built up or utility. Utility is very unlikely. But what's interesting is like all of these older meme coins have not seen the same amount of attention as the newer ones, like a Bonk on Solana or a Pepe or a Doge or a Shib. Comparatively, they haven't, which is very interesting to see. I think we're seeing a new wave of meme coins now.
My thoughts, and I could be wrong, is that once the year or 2 years or whatever, how long if it doesn't build up social capital, all that value will flow back into the Solana main chain.
Agreed.
Okay, great. I'm thinking correctly then. So, thank you. So, another thing, that has affected, the market, and they're not as popular, I guess, but they are kind of like NFTs. They are Bitcoin ordinals, right? And that has affected the main Bitcoin chain. And with the halving coming up in, what is it, the 15 days? What do you see as far as the Bitcoin, ecosystem, as far as the price of Bitcoin happening and the value of the ordinals?
So historically, whenever the halving happens, I think a year to a year and a half before, there is historically price action. So if the halving is scheduled for somewhere at the end of this month, the price action started early last year, which is true. And that's exactly when ordinals were announced. Ordinals, I think, sort of came up in December 22, January 23. And then inscription sort of took off and they got a new token standard. NFT marketplaces started supporting them, wallets started supporting them, etc. So as far as the halving and the ordinals go, I think the timing was very right, regardless of the ETF, based on historical price actions of the halving. Once the halving takes place, Bitcoin's supply is usually crunched because miners get a smaller share. They might hold on more, or they might sell more, etc. Last time, I think in 2020, when the halving happened in May 2020, I remember the price of Bitcoin following the COVID crash was $3,000 to $5,000, and as the year progressed, it inched up to $15,000 to $20,000, and then a year later in 21, it was close to $70,000, from which it started descending. Right, so there was a lot of fervor after the halving, because people had less Bitcoin that they received, and there was generally a supply crunch for the miners, which could be the case this year. But this year, the difference is that for the first time, Bitcoin has monetary utility beyond just monetary security. People can actually use the Bitcoin to pay for fees for getting a piece of media inscripted on the Bitcoin blockchain, which is kind of the same thing as an NFT. And given that we've seen support for it, we could see a lot of lot more ordinals sort of kick off, provided the fees are tempered. I think the fees rose significantly last year during the ordinals hype, and since then has descended as price action fell, and right now it's coming back up again. Few interesting things that I'm seeing. One is from Magic Eden. I think there's something called Bitcoin runes that the developer who started the ordinals inscription is sort of launching, which is similar to ordinals itself, but it has easier minting and transacting, which is going to sort of increase the velocity at which people trade ordinals. If the attention still comes, we don't know. But the way I see it is that attention for monetary utility on Bitcoin is lower than on most other chains, simply because applications are lower on Bitcoin compared to Ethereum and Solana. And people don't see it as such. They see it more as a buy and hold, buy and transact, buy and move capital around in dire straits, as opposed to use it. But ordinals proved it otherwise, where there was $1 billion of more of trading volume on ordinals marketplaces combined, and maybe even individually. I'm not sure. I think Magic Eden leads that race. So there is a lot going on, but yeah, it's interesting to see Bitcoin moving from security to utility.
So it is. I agree. So I'm thinking, we talked about blobs, we talked about memes, we talked about ordinals. Are any of these things on the radar of your institutional clients? Are these extra things, or are they sticking with, their look is at the institutional metrics? What is their consideration in this market?
In terms of what their views are, it's of course very diverse. But ordinals is something that people are looking at for Bitcoin specifically, because the value eventually boils down to Bitcoins, not specifically projects on it, although there are some interesting projects on it. From a meme coin perspective, it's usually the base layer that is seeing a lot of interest, whether that base layer is the chain itself, which is Solana, or the protocol that is garnering the most amount of volume, like Jupiter or Orca or Radium, etc. But an interesting use case that a lot of people are seeing is the development of alternate layer ones that are both EVM and non-EVM. One example could be Monad, that's an alt layer one, but EVM compatible blockchain that is coming up. I think they've launched their DevNet recently, and they will launch their mainnet in Q2 of this year. People are looking at non-EVM alternative layer ones like Sui, like Say, like Aptos. There are a lot of projects building on top of them. Those are interesting. That's not something else institutional clients are looking at. Clients are not specifically looking at, I'm not talking about our clients, but institutions in general, are not specifically looking at NFTs, either because they're still suffering a down cycle, especially on the Ethereum side, but later on will come back up. Probably, I'm not too sure about that. Alt L1s, what am I missing here? Base layers for trading meme coins is going up significantly. We did a couple of back of the napkin analytics on Radium versus Uniswap, right? Radium is sort of the premier marketplace for Solana trading volume, or either through aggregator or not, but they're executed on Radium. And it's trading at a very smaller multiple to Uniswap, which is the premier trading venue for Ethereum or all EVM chains. That's another interesting use case to look at. So I think to sum up my answer, application layers that facilitate a frenzy like meme coins works really well. Alt L1s, EVM or non-EVM, that is also an interesting use case.
Awesome. So I have that's a couple last questions. I want to talk about derivatives, right? So I want to find out what the state of the funding rates across derivative exchanges are in both CeFi and DeFi, and like what your thoughts are on when we're going to be triggered for the next DeFi rally, which we had like 2021, I think.
So start off by saying that most derivatives volume happens on centralized exchanges. I think close to 90% of trading volume happens on centralized exchanges. Now that's spread between Binance, Bybit, um, BitMEX, etc. But it happens on centralized exchanges, all of which have a positive funding rate right now, which means there are more longs than shorts, and longs are paying the shorts. So you would make money if you open a short position, but if the market goes up, you are liquidated. And that is true on decentralized exchanges as well. I looked at the funding rates for Bitcoin on DYDX and Ethereum on DYDX, significantly in the green, which means it is positive. So there is an overwhelming sentiment of going long in the market. Therefore, if you go short, you will sort of benefit again. But again, if the prices go up, you're screwed. So that's the general theme. And I think this theme has been true since October 2023. And that's, I'm not sure what the price was, but it's somewhere around 30. Bitcoin was somewhere between $30,000 to $40,000. But one interesting thing that I was looking at before this call again is the leverage rates, the open interest leverage, which looks at an exchange's leveraged position of Bitcoin, Ethereum, etc., to the coins that it holds, which means how many people are trading on leverage. On centralized exchanges, there's not a lot, which is very surprising. In fact, the leverage for Bitcoin is dropping, has been dropping since early 2024. Right? Ethereum is going up marginally so, but it is going up more so compared to Bitcoin, which either means that people were trading on leveraged longs later in 2023, which is probably the third or the fourth quarter of 2023, somewhere around September onwards. And they either made money and they moved out and they don't want to leverage longs again, or people think that the market is too in the green to leverage upwards, right? So just a couple of combinations there. Funding rates are positive, both Ethereum and Bitcoin. But for Bitcoin, the leverage ratio is dropping, which means people aren't taking leverage long bets. They're still taking long bets, but they're not taking leverage long bets, which means they expect the price to go up, but not at a high degree, or not like a 10%, 20% in a week kind of. In Ethereum, longs are still dominant. Funding rates are still positive. But the leverage ratio is increasing, which means that they think that the price of Ethereum, if it goes up, can go up substantially, right? Which is true if you just look at like the all-time high difference. Bitcoin is well past its 2021 highs of $69,000. Ethereum is still hovering below. I think it was 4,800, and now I think it closed up at 41, maybe 40, but it didn't come close to the 4,800 mark. Given sort of maybe increase in fees, most value accruing to L2s, L1's doing really well, etc. So that is just an interesting thing that I'm seeing right now with perpetuals and their funding rates for Bitcoin and Ethereum.
Really interesting. Really interesting. Wow. Cool. And so that when do you see the next DeFi summer?
I think it's happening. If we look at like the DeFi summer of 21 was when a lot of DEXs started coming up. They started creating a lot of pools, and people started farming for yields by depositing ratios of tokens that other people could then trade, right? So because a lot of new traders came in, a lot of those pools became or were utilized, and the rates sort of increased. And that is happening to some extent on the trading side, where if you go to a lending marketplace on Solana, people are depositing a lot of stable blue chips. By stable blue chips, I mean something like a wrapped Bitcoin, a wrapped ETH, or on Ethereum marketplace or a wrapped Sol or Sol itself on Solana, or on the Ethereum marketplace, they're depositing wrapped staked ETH. That is, in fact, the highest. This is very interesting, right? I was looking at the Aave collateralized amount, the collateralized assets on Aave, and the most increase in a collateralized asset class was on wrapped staked ETH, which grew by about 10x in the past year, which means more people deposited wrapped staked ETH than any other asset to borrow stable coins, presumably to trade. It can be for anything, but presumably to trade. And they were paying a high interest there, right? And people who deposited sort of smaller coins also earned a lot of interest, and that's happening on Solana as well. So I think DeFi summer is happening currently, simply on the trading side, because people need USD equivalents, USDC, USDT, USDE to trade. Some of the rates are bonkers. Even for stable coins, it's going up to 100% plus, but those are on sketchy stable coins that the peg is questionable. So that's still happening. But to answer your question, when and where, when probably it's already started. Where it's on any marketplace that allows you to lend an asset that can be used, or give an asset, it can be lend, it can be deposited in a pool, anything that can be used to trade. It also, restaking and staking marketplaces have seen a significant amount of interest on alt L1s, right? I was looking at Celo Stake, the staking and restaking platform at for Say, the new L1 blockchain. Not new, but fairly recent. That's also seen a significant increase in people staking their Say, and the rates are very low, right? The rates are comparatively low, comparatively to say a Solana, which is 7.45%. It's about 3 to 4%. So that's still happening, maybe at a different level, and again to trade right now. But of course, the use of it can change over time.
Oh, this is very fascinating. I want to thank you very much for your time today. This has been great. And I learned a lot. So definitely appreciate it. Thank you very much. I have one last question.
Sure.
And really, how can people find out more information about you, about PYOR? How can they use your protocol platform? How can they do that? How can they learn more information or become institutional clients as well?
Sure. Thank you for asking that. You can head over to our website, pyor.xyz. There, if you are an institutional client, you can sort of register your interest, and we'll get back to you on any data needs that you need. If you want to use our platform, there's of course a tab right there. You can use our platform right from the app. I would encourage you to look at any protocol that you like, but the metrics that we track quite deeply are for DEXs and lending platforms, also for L1s, and we have over like 20 plus L1s there. We also built our own benchmark for DEXs. So if you want to compare an EVM DEX to either a benchmark or to peers, that's a good way to check it out. We publish a lot of content in the form of research as well as interviews on our Twitter, PYORXYZ, at PYORXYZ, on LinkedIn as well, Farcaster as well, and YouTube and the rest. So please check it out. And if you have any feedback on the data, if you want to get your own custom dashboards built, happy to do that. You can reach out to me directly, or reach out to Pure, and I can get back to you.
Awesome. Thank you very much for your time today.
Thanks a lot, Jamil. Thanks to God for hosting the podcast. Really interesting questions, and I hope your viewers, listeners had or learned something.